Today we're gonna get real. We're gonna explore all the different assets that you can invest into for 2022. And this week we will start with all the classic assets, and next week we will go into the more exotic assets. More than that, we will look at what they are, why you would want to invest into them, their historical performance, and how you can purchase them. And I will share with you at the end a super important risk that you need to take into account before investing in any of those assets. Ready, set, go! Let's start with the helicopter view. So this picture gives you a quick overview of the main asset classes and how they performed over the period from 2007 to 2021. That is by no means the only period to look at, but it gives you a good overview of how assets move overall. The asset class represented are stocks, REITs, which is property, bonds, cash, crypto, hedge funds, and private equity. I'll go into the details of all of what it means in the description of each asset class when we do that next. This is mostly for the US. This is the most developed financial market in the world and where you can easily find the data. So what strikes you when you look at this? It's all over the shop. No one asset class stays consistently at the top. Every year things are moving around and you can see that some end up at the top, bottom, middle, moving across the years. And the more exotic they are, the more you will find that they are very volatile, like crypto, hedge funds, private equity, for instance. Cash. Supposedly the most secure asset, the one we put under the mattress when we are worried about the future. Here we're talking about that can be cash in the bank or in your hands, something which is easily accessible in your savings account. Also US short-term treasuries are considered very safe. The 3-month treasuries are considered as very safe assets, so that's why they're considered close to cash. And here you can see the performance over the years. As you can see, it's not a great interest. It actually used to be a lot better back in the 80s when inflation was high, but it's been progressively going more and more down, so it's not too exciting, but that's better than just pure cash. Also something to know, cash and interest in some developing countries can be quite interesting and much more than in developed countries. What comes with it is a very different risk profile though, and it is key to check if the country's currency is getting stronger over the long term or weaker compared to your main expense currency. So what are the reasons that you would be investing in cash and keeping cash? Well, that's building the foundation of your investment plan, so that's fairly low risk. Easily accessible reserve funds in case of problems, that's also a very low risk profile. You understand exchange rates evolution very well and what to play in different currencies. So that's a bit daredevil, that's currency trading, that's not easy. You're worried about the immediate future and want to keep money mostly in cash, so that's a low risk approach too. And how do you access cash? Well, bank account in your country, other countries allowing you to have one if you're a foreigner, trading platform also like Interactive Brokers, Fidelity, Toro, Robinhood, etc. Can get you access to cash very easily. To conclude, cash is low risk asset. At the same time, there is a big risk actually linked to cash, and I will talk about it a bit later, so stay tuned. Precious metal. Precious metals, gold, silver. Who is not attracted to shiny things? So precious metals, we have gold or silver in their physical form at home. Gold or silver that is secured through a company holding in its vaults. You can have a proxy also, ETFs, so exchange traded funds, mutual funds which are owning gold in physical form, and other precious metals like platinum or palladium. On this chart you see the performance of gold and silver since 1915. As you can see, not much was happening until the 1970s, which is when the US stopped convertibility of the US dollar into gold, and the return since then has been interesting, though with long period of underperformance, so you have to catch this market at the right time. And why would you invest in gold? Well, you might want to be building the foundation of your investment plan, so that's a low risk approach. Protection from apocalypse, but accessibility might be an issue, and also you cannot eat gold, so that's a very low risk perspective. You might be worried about the current situation in the world and you want to keep money in cash, and you're worried about money printing, so that's also a low risk approach. And how do you access it? Well, you have any shop selling high carat jewelry, gold or silver. You can melt your electronics, but do not do that at home, please. And you have custodians like goldmoney.com, royalmeat.com, etc. Bonds, but that's another asset which has a very varied risk profile, and you might have very low risk profile, you might have very high risk profile. And here we have sovereign bonds, whether they are short-term or long-term. That can be countries or municipalities' debt. You've got corporate bonds with high grade, which tend to have low yield. Low grade with high yield, which are also called junk bonds. And you have mortgage-backed bonds, which is on the property side, and in the form of the actual bonds, or you can have that as an exchange traded fund. Looking at the performance of sovereign bonds, it's the country's debt. This varies wildly depending on the state of a country's economy. Some countries like Germany make you pay for the privilege to own their bonds. Others like Argentina will give you a nice coupon or interest, but it is not entirely sure you will get your money back. High grade, low yield, that's for corporate bonds of companies which have a solid financial performance, usually better returns than sovereign bonds, but more volatile. And then you have low grade, high yield, also called junk bonds. This is for corporations with very weak financial performance. You certainly take a lot more risk, but you also have potentially a lot more reward. So why would you invest in bonds? Well, traditionally there is a portfolio called the 60-40 investment portfolio, where you would have 60% of your portfolio in shares and 40% in bonds. It's considered as something which is quite safe and at the same time provide good returns. So bonds have had very poor returns in the past 10 years. Because of rising interest rates, you might bring bonds back as good investment in the future, so you might want to look at that, but that's pretty risk adverse. And taking high risk on high yield bonds, so that's more of daredevil, and you need to know what you're doing in terms of analyzing the companies. How do you accept bonds? Trading platform are the best way to do that. Interactive Broker, Fidelity, I've talked about them before, so those are great to actually access bonds. And there is an important risk also with bonds that you need to consider, which is also similar to cash, and I'll talk about it later. You know the drill. If you like this video, please do smash the like button and subscribe to the channel. Also, don't forget the notification if you want to receive all the videos every week. REIT and properties. Now that is a solid asset, and I have mine all around me. There are many ways that you can invest in property, whether it's for your primary residence or if it's because you want to build a portfolio of properties to actually get revenues. So we will look at all the different type of property investment that you can. So what are properties? So properties themselves, so actually the actual physical goods that you live in, that you purchase. You can buy REITs, which are real estate investment trust, and they have different categories. You have the retail ones, which are about shopping malls or the shops, residential with houses and apartments, healthcare, hospitals, retirement homes, office buildings, and mortgage, also homeowners mortgage REITs. And then on top of that you have exchange traded funds of REITs, which are usually more accessible, easier to access. Here you have a picture which is showing the different type of returns that you can get on property in different countries. As you can see, it varies a lot depending on the country, and it varies a lot depending on the years that you're looking at. So it really depends on where you live, and it depends on where you're comfortable to actually buy properties. REITs are also very diverse. It's very visible that you can do very well in certain countries at certain time and with different type of REITs. So it's a question of timing and finding the right type of REIT and understanding where you are in the market for that specific REIT. So some reasons that you might want to invest whether in property or REITs. First, as your primary property, that's a roof over your head, so that's pretty important, and that's a normal risk, minimal risk type of approach. You can also do as a portfolio of rental properties to realize recurrent income. That I would say is more of a medium risk. It demands a lot of capital to actually get there, and I wouldn't do it with 1 or 2 properties. You probably need more to actually manage the risk of the different income sources. Can also be a bet on specific types of REITs or ETFs, so that's a medium risk to actually daredevil level. It depends on how volatile the market is in which you're trying to invest and how much you actually understand it. Can be part of a diversified portfolio to balance your returns, so that's a medium risk approach, and also for fast purchase and sales of property in hot places where prices are moving fast. You gotta be careful with that. That's very daredevil, and it's really a question of timing, so knowing the market very well. So how do you access actually property and REIT? Well, the first one obviously is your local real estate agent, or you can buy direct owner to owner. You can also use online real estate platform like Prosper, Lending Club, etc. On trading platform, you'll be able to buy the REITs or the ETFs, and you have the usual players here. Property and REITs are very diverse type of assets. You can really have a very low risk approach, or you can have a very high risk approach depending on what you do. It's a very good basis somewhere in your portfolio to have a solid investment portfolio. The stock market. Place where riches have been made and lost. It's an incredibly varied field, so I will try to keep it simple for you. What have we got here? So it's shares of companies, obviously, so it's common stock, preferred stock, Class A, Class B type of stock, so ownership of part of the company, basically. There are many groupings which are possible about these type of companies. It can be large cap, which is large capitalization, which are usually large companies. The mid cap is medium-sized companies, small cap, small-sized companies. It can be a growth or a value stock, I'll explain that later. It can be about companies which are focused on dividends, so they give regular dividend to the owners. It can be sectorial, so it can be about a specific different industry, whether it's IT, high-tech, it can be about petrochemical, etc., etc. And there are many other type of groupings that you can have about stocks. You also have the mutual funds of stocks, okay, and ETFs, so exchange traded funds of stocks also. There's many different ways you can look at the performance. Here we're looking at large and small cap, for instance, with emerging markets. Large caps dominate, and that is mainly due to the growth of tech companies in that period in the US. You can also take a country view, and outside of the US you can see that other international markets, which vary wildly again, and the only one to beat the US stock market over that period has actually been Australia. You can look at growth versus value. Growth stocks are considered higher growth potential but are more volatile, while value is focusing on companies underpriced but with good fundamentals and less volatile. In the past 15 years, growth has beat value in terms of return, as you can see. But this has not always been the case, as you can see here, and over a long period of time, so beware of the changing trends. So what are the reasons why you would invest in stocks? Well, you might want to own companies that you believe in and for which you buy products, so that's medium risk to daredevil, depending on the research you've made on those companies. You can have that as part of a diverse portfolio to balance your returns, so that's medium risk. You can also do value investing, so you buy low and sell high, or you never sell, that's low to medium risk. Growth investment, wanting higher returns, so that's medium to high risk, daredevil. And active speculation on day trading, that's definitely daredevil, and you definitely need to know what you're doing with that. With regards to how to access, the best way is definitely the trading platforms, and I've talked about them, you can see the names here. So stocks for sure is a place where you can invest your money and you should be looking at. I've given you a few of the different aspects that you can consider to actually go into the stock market. So do your research before you jump in. Now, one major risk to remember, okay? And we're all facing it right now, and it's the debasement of money. On this picture you can see the amount of money which has been printed by the main central banks in the world, and it's huge. All this money needs to go somewhere, and many times it's actually going into all those assets that we've talked about. So they are all becoming more interesting in terms of return, but at the same time they're becoming a lot more expensive to purchase. And this money is also going to loans, to companies, to people, and that also tends to inflate all the asset prices. And if there are more and more people buying, then we can have a supply crunch, for instance, and with a law of supply and demand, well, that makes all the prices increase progressively. To illustrate this in a simple manner, we can just take a look at the price of a Big Mac over time. It's exactly the same burger, and its price has been multiplied by almost 4 over this period of time. So if you want to learn more about this major risk in our life nowadays, go take a look at this video here and here. I'm talking about the inflation and how actually to fight and live with it. And if you've missed my video about understanding what type of investor you are and actually how you can create principles for your investment portfolio, then go take a look at this video in the description, and also here it will help you navigate that first before you actually start to build your investment portfolio. Alright, now you've got a good grasp of the classic assets and the roles that they can play in your portfolio. Next week, we're actually going to go with the exotic assets, things which are more risky, a bit more fun, but also like difficult for the ride sometimes. So stay tuned and see you next week for the exotic assets. And before you ask, yes, we will talk about crypto. Keep learning more about personal finance and how to make those important choices which are moving your personal finance life in the right direction. And I will see you in the field, special agents.